Welcome to the table where the green meets the gold. Green meets the gold.
Welcome back to the $50 Dividend Investor Podcast, the show that proves you do not need to be wealthy to start building wealth. I am your host, KR Talon, author of the $50 Dividend Investor, available on Amazon. Each episode, we take one powerful concept from the world of dividend investing and break it down in plain, everyday language. No jargon, no fluff, just a clear and honest roadmap for the everyday investor. Let's get into it. Imagine a company that raised its dividend payment to shareholders every single year for the past 25 years. Not most years, not good years, every year. Through the dot-com crash of 2001, through the housing collapse and financial crisis of 2008, through the global pandemic of 2020, through every recession, every market correction, every period of economic uncertainty the world has thrown at it over the past quarter century, this company looked at its shareholders and said, "We are raising your dividend again this year." How many businesses do you think can make that claim? More than you might expect, and they have a name. They are called Dividend Aristocrats. And by the end of this episode, you are going to understand exactly what they are, why they matter, how to access them on a $50 budget, and how they fit into the portfolio strategy laid out in the $50 Dividend Investor. Welcome to Episode 6.
Let's start with the official definition, because precision matters here. A dividend aristocrat is a company that is a member of the S&P 500 index and has increased its dividend payment every single year for at least 25 consecutive years. Both conditions must be met. The company must be in the S&P 500, meaning it is among the 500 largest publicly traded companies in the United States, and it must have that unbroken 25-year streak of annual dividend increases. As of recent counts, there are approximately 65 to 70 companies that qualify. That is a small and elite group out of the thousands of publicly traded companies available to investors, and membership in that group is not given. It is earned through decades of financial discipline, consistent profitability, and a genuine commitment to rewarding long-term shareholders. Now, here is what I want you to think about when you hear that 25-year requirement. That streak had to survive the year 2000, when the technology bubble burst and the broader stock market lost nearly half its value. It had to survive 2008 and 2009, when the global financial system nearly collapsed, unemployment spiked to 10%, and hundreds of companies suspended or eliminated their dividends entirely. It had to survive 2020, when the economy shut down almost overnight and thousands of businesses cut their dividends to preserve cash. A company that kept raising its dividend through all of that was not lucky. It was structurally sound. It had a business model resilient enough to generate consistent cash flow in the worst environments imaginable. It had management disciplined enough to prioritize shareholder returns, even under extreme pressure. And it had the financial strength to back that commitment with real money, quarter after quarter, year after year. That is what you are buying when you buy a dividend aristocrat. Not just a stock, but a track record of demonstrated resilience that very few companies in the world can match.
What kinds of companies make up the Dividend Aristocrats list? The largest concentration is in consumer staples, companies that produce and sell everyday essential products. Think of the brands you buy at the grocery store every week without thinking. The toothpaste, the cleaning products, the beverages, the packaged foods. These businesses generate cash flow that is remarkably consistent regardless of the economic environment, because people do not stop buying necessities during a recession. They buy less of the optional things, the luxury goods, the discretionary purchases, but they keep buying the essentials. That predictability is what funds a 25-year dividend streak. Beyond consumer staples, you will find significant representation in healthcare, industrials, and financial services. Each of these sectors shares that same characteristic of durable, recession-resistant demand that allows a company to keep growing its dividend even when times are hard. One of the most common questions I get about dividend aristocrats from readers of the $50 Dividend Investor is this: are they affordable for a $50 investor? And the honest answer is that some of them are and some of them are not.
at least not in terms of buying a full share. A handful of aristocrats trade at prices that would require several months of contributions to purchase even a single share. But here is why that concern is largely solved by the modern investing environment: fractional shares. As we discussed in episode 2, fractional shares allow you to purchase a slice of any stock for whatever dollar amount you have available, regardless of the share price. If a Dividend Aristocrat trades at $400 per share and you have $50 to invest, you can purchase 1/8 of a share. That fraction earns dividends proportionally, participates in DRIP reinvestment, and grows with your portfolio exactly like a full share would. The price of a share is no longer a barrier to owning the best dividend companies in the world, and that is a genuine game
Welcome
changer
to
for the $50 investor.
where the green meets the gold. Green meets the gold. I'm KR Talon, and we're planting seeds today, not just checking the ticker.
Now, I want to introduce you to a category that sits above even the Dividend Aristocrats, a group so rare and so impressive that when most experienced dividend investors hear about them for the first time, their reaction is genuine disbelief. They are called Dividend Kings, and the qualification is exactly what it sounds like: 50 or more consecutive years of annual dividend increases. 50 years. Think about what the world looked like 50 years ago. The internet did not exist. Personal computers did not exist. The smartphone was decades away. The global economy has been transformed multiple times over in 50 years, and these companies have raised their dividend every single year through all of it. There are fewer than 50 companies in the entire United States stock market that qualify as Dividend Kings, and every single one of them represents an extraordinary combination of business durability, financial discipline, and shareholder commitment that is essentially unmatched in the investing world. You might be wondering, if Dividend Kings are so impressive, why not just build your entire portfolio out of them and ignore everything else? It is a fair question, and the answer has two parts. First, Dividend Kings tend to have lower yields than younger, faster-growing dividend payers. Because their share prices have appreciated significantly over decades of consistent performance, the yield, which remember is the annual dividend divided by the current share price, is often in the 2 to 3% range. That is a perfectly respectable yield, especially when you account for the growth rate, but it means your early income from a Dividend King position will be modest. Second, Dividend Kings are concentrated in a relatively small number of sectors, primarily consumer staples and industrials, which means a portfolio built entirely of kings would lack the sector diversification that protects a beginner investor from sector-specific downturns. The right approach, and the one I lay out in the $50 Dividend Investor, is to use aristocrats and kings as the anchor positions in your portfolio, the stable, reliable core, while complementing them with other high-quality dividend payers in sectors like utilities, healthcare, and real estate that provide additional income and diversification.
So how do you actually find out which companies are currently on the Dividend Aristocrats and Dividend Kings lists? The good news is that this information is completely free and updated regularly. The website dripinvesting.org maintains a comprehensive and regularly updated list of both aristocrats and kings, including their current yield, their consecutive years of increases, and their 5- and 10-year dividend growth rates. It is one of the 3 free research tools I mentioned in episode 3, and for researching aristocrats specifically, it is the single best starting point available to any investor. You can sort the list by yield, by growth rate, or by sector, and within minutes, you can identify the companies that best fit the sweet spot framework we discussed in episode 4, a yield between 2.5% and 5%, combined with at least 5% annual dividend growth. Running that filter on the aristocrats list alone will surface a manageable shortlist of high-quality candidates for your beginner portfolio.
Now, let me answer the question in today's title directly. Do you actually need Dividend Aristocrats in your portfolio? Here is my honest answer. You do not need them. There are high-quality dividend stocks outside the aristocrat list that pass the 3-question checklist and deliver excellent long-term results. But here is why I recommend them to beginner investors specifically.
When you are new to investing, uncertainty is your greatest enemy. Every time the market drops, every time a headline screams about economic trouble, every time your account balance dips below what you contributed, your instinct is going to tell you to sell. Having Dividend Aristocrats in your portfolio gives you something concrete to hold on to in those moments. A track record of 25 plus years that says this company has been through worse than this and kept raising its dividend anyway. That track record does not guarantee future performance, but it provides a foundation of evidence that makes staying the course dramatically easier. For a beginner building their first portfolio, that psychological anchor is worth just as much as the financial one. Everything covered today is expanded in the full portfolio framework in the $50 Dividend Investor by K.R. Talon, available now on Amazon. Link always in the description. Next week, we are tackling a topic that most new investors avoid entirely, but absolutely cannot afford to ignore. Taxes and dividends, what you need to know before you invest your first dollar, and the one account type that changes the tax equation entirely. Subscribe now so you do not miss it. Start small, think long, build forever.
Welcome to the table where the green meets the gold.
And that is episode 6 of the $50 Dividend Investor Podcast. Dividend Aristocrats are not just a list of stocks, they are a 25-year proof of concept. And Dividend Kings take that proof even further, to 50 years and beyond. You do not need them to build a great dividend portfolio, but for a beginner who needs a reliable anchor to hold on to when the market gets turbulent, there is nothing quite like a company that has raised its dividend every year for a quarter century. That track record is your evidence. Hold it confidently. If you are ready to go deeper, the $50 Dividend Investor by K.R. Talon is on Amazon. Link in the description. The full Aristocrat and King framework, portfolio building strategy, and stock selection criteria are all covered in detail. And if this episode helped clarify something you have been wondering about, share it with a fellow investor who is still trying to figure out where to start. Next week, we are covering the topic most new investors avoid: taxes and dividends. And it is one of the most important episodes of this entire series. You cannot afford to miss it. I will see you there. Start small, think long, build forever.
Welcome to the table where the green meets the gold. Green meets the gold. I'm K.R. Talon, and we're planting seeds today, not just checking the ticker. Not just checking.